this week or next week in China to ratify the whole unit discussion to then bring it to the meeting in October. Yes, I mean it's certainly on the docket to be discussed. And here's the thing, man, even if they don't ratify it yet and don't bring it out, hey, you can see the handwriting is on the wall. And it's coming one way or the other. I would say they're definitely going to discuss it. Will they announce it? Don't know. Maybe that's why the Fed dropped rates by 50 basis points, even though the economy is supposed to be so glorious and the stock market at all-time high and unemployment so low. Thing is that the unemployment numbers that they use are fugazi, and the 4% unemployment traditionally would be record low, would be really, really good. But the U6 number that they used to report up through the 90s is almost 8%. And that's far more realistic than the numbers that we are being told, especially since we already know that 1 million full-time jobs were lost last year, replaced by 665,000 part-time jobs, largely from undocumented immigrants. And at the same time, 1.3 million jobs were full-time jobs with benefits to American citizens, and those are gone. And then they revised the numbers down by 818,000 jobs, along with a couple 100,000 throughout the year. In other words, another 1 million jobs. It's all a bunch of bullshit. It's not the Bureau of Labor Statistics, it's the Bureau of bullshit. And that's the part that bothers me, is that they're painting a picture that isn't real, and it's as if they see something coming. Could it be a massive recession? You know, we've talked about last week when the inverted yield curve, the longest ever and steepest, inverts every single time since 1950, it has predicted a recession without fail, 100%. Or Claudia Sam's rule, I think it's Sam or Sam, I'm not sure, SAHM, where she talks about a 3-month rolling average of unemployment. And if it rises 50 basis points from its low point, you're in a recession. Well, it's up 53 basis points. It's predicted a recession 9 times in a row with 100% accuracy. Are we in a recession? Is that what they're worried about? Could it be something far worse? Could it be something that comes out of Brics? Are they going to try and do something to stop that Brics meeting from happening, to stop the election from happening? God forbid. But I want you to think about something. You know, I was listening to a podcast the other day with RFK Jr. He's like, you know, the Ukraine and Russia have a 2,200-mile border, and NATO is talking about putting these Aegis missiles on the border, which can carry a nuclear warhead and would beat a Moscow in 3 minutes. If it were on the Mexican border, would we stand for this in 1 second? And so you can understand that you wonder to what lengths will they go to keep Trump out of office? Does it mean even doing something to perhaps delay the election or cancel the election? And that's not so far-fetched. That actually is what's happening right now in the Ukraine, where Zelensky has suspended, the elections under the guise of martial law because they're in the midst of a war. God forbid that's the lengths to what we would see here. But like I said, man, these are going to be the craziest now 8 weeks maybe of our lives. I really do believe that. I can't wait to ride shotgun with you, and hopefully it's not too crazy so we can talk about it and still enjoy life. Right?
First, let's talk about what's happening globally. Andy Schectman, our featured speaker, has been discussing some major moves on the international stage that are poised to shake things up for the precious metals markets. One of the key developments is the upcoming meeting in China, where the Brics nations are likely to discuss a new unit of trade. Whether they decide to ratify it this week or next, the writing is clearly on the wall. It's coming, and it will change everything. Even if there isn't an immediate announcement, the conversation itself is important. The mere fact that this topic is on the agenda tells us something big is in the works. It's possible that the Fed is even aware of this, and that's why they decided to lower interest rates by 50 basis points. Now, you might be wondering, why would the Fed lower rates at a time when the economy is supposedly doing well? The stock market is at an all-time high, and unemployment is reported to be at record lows. But are those numbers real? The real unemployment numbers? Here's the thing. The unemployment figures that are touted by the Bureau of Labor Statistics, BLS, are misleading. They tell us the unemployment rate is around 4%, which sounds great. However, when we look at the more comprehensive U6 number, which was used up until the 1990s, the real unemployment rate is closer to 8%. What's going on here? It's not just about the headline unemployment rate. It's about the quality of jobs that are being created. Last year, over 1 million full-time jobs disappeared, replaced by only 665,000 part-time positions. Many of these new jobs went to undocumented immigrants, which changes the dynamics of the labor market and the benefits associated with it. Moreover, recent revisions to the employment numbers have reduced the official figures by another 88,000 jobs. When you look at the big picture, the story changes dramatically. The economy isn't as glorious as we're being led to believe. That's why it's so significant when Andy talks about the Fed's rate cuts. These decisions are not being made in a vacuum. They are a response to something brewing beneath the surface, something potentially much more dangerous than a recession. In fact, the yield curve has been inverted for the longest period in history, and every time since 1950 that we've seen this kind of inversion, it has accurately predicted a recession. We're also seeing a rise in unemployment rates following the Claudia Sahm rule, which states that an increase of 50 basis points in the 3-month rolling average of unemployment signals a recession. We're already up 53 basis points, indicating we're in the danger zone. The Brics alliance and its implications for gold and silver now, let's zoom out to the global stage. The upcoming Brics meeting is something that investors around the world should have their eyes on. We're talking about a coalition of nations including Brazil, Russia, India, China, and South Africa that are looking to reshape the global financial landscape. One of the topics on the agenda is the establishment of an alternative to the dollar for international trade. This move has the potential to upend the current financial system and significantly impact the value of both gold and silver. If the Brics nations decide to launch a new trade unit, it could accelerate the decline of the US dollar's dominance. And here's where it gets really interesting. As the dollar loses its status, we can expect gold and silver to surge. These metals have always been seen as a hedge against currency devaluation. And with the dollar potentially on the ropes, the value of gold and silver could skyrocket. One of the reasons for this is simple. When countries no longer rely on the dollar, they look for other stores of value, and precious metals are the natural choice. We've already seen Russia and China loading up on gold, and Saudi Arabia recently bought 160 tons of gold from Switzerland. All of this points to a clear trend. Nations are diversifying away from the dollar, and gold is the key alternative. You might think it's a stretch to link geopolitical tensions with precious metals, but history has shown us that during times of war or heightened geopolitical risk, gold prices tend to rise. Why? Because gold isn't just a hedge against inflation, it's a hedge against chaos. And with the world as unstable as it is right now, it's no wonder that gold is rallying. With gold prices up $30 today, reaching around $2,660, and silver up 5.2%, sitting at $32.30, we're starting to see some serious momentum. This kind of movement isn't just random, it's a response to all the factors we've discussed: currency devaluation, geopolitical tension, and the erosion of trust in financial institutions.
We're less than a month away from the Brics meeting. I think it's October 2nd in Kazan, I think we pronounce it. And maybe 6 weeks away from the biggest election in this country's history. So, and what do we have? We got gold breaking out. Gold up $30 today, 26.60 basically, and silver up a big 5.2%. Up $1.60 to 32.30. I mean, that's the thing, you know, that people talk about the gold silver ratio. So gold was up 1.1% and silver up 5.1%. It outpaced it by a factor of 5. That is the gold silver ratio in a microcosm, just a little tiny piece of what you could expect when silver catches up, which I think it will. I think that silver, you know, look, you're the silver slayer. I'm on your show. I own a silver company. Who cares? The truth of the matter is that silver is probably the most undervalued asset on the planet. And, you know, you look at the Fed now cutting rates at a time when we're, for the first time, really, in almost a year, we're seeing a little bit of an uptick in the ETFs from the West. So just to set the stage, you know, we've talked about the ETF holdings going down like this as gold and silver have been going up like this, which is usually incredibly negative for the metals market. At the same time, you had a positive real yield. Forget about the nonsense out of the BS, I mean the BLS. and their CPI, forget about that. Let's just pretend that it's real. And you have a 5% 6-month treasury yield and a 3.5% or 3.3% inflation. It's a positive real yield, downward sloping participation in the ETFs, and a strong dollar. That's the death knell for gold and silver, yet somehow it keeps going higher. And now when you see for the first time in a long time that slope in ETFs has gone like this, it's starting to go back up. And I think that component, the precious metals in particular in gold, but also in silver, that ETF component has been absent largely over the last 2 years. And I think you add that in on top of all the things we've talked about, like our interview with Sean we did not too long ago really had a great impact on me, where we discussed China going around the world, in particular Latin America, and buying up the doré and the concentrate. That's huge, right? Because that's just like the People's Liberation Army, right? No one talks about the PLA. They talk about the PBOC, the People's Bank of China, and their purchases have to be reported to the IMF. And well, we stopped buying gold for a couple of months. No, you didn't. The People's Liberation Army doesn't have to report it, and they probably have more gold than the PBOC does. So the point I'm getting at is that there's a tremendous amount of effort to conceal just how much gold and silver the rest of the world is buying using the suppression of our markets, the brain dead suppression. And we've been seeing this great growth largely in gold, with silver lagging, which is typically the way it works too, my man, because gold goes up first and silver catches up like a slingshot. It's like if you ever gone water skiing and you go around a curve on a boat and it gets to that point where it just goes shoom. And that's what would happen here traditionally, where silver outperforms gold later on. And that's kind of what we see today here, where a 5% gain. Now, that's just a small snapshot of what it would look like, but 5%, it outpaced its gain today 5-1, yet gold is up $30. It's distorted by the dollar figure of silver being up $1.60, but percentage wise, it's 5 times the gain. So anyways, what I'm getting at is that now you add into an ETF, positive ETF inflow, and the Fed pivoting, you're going to add, I think, a lot of upside to the gold and silver market that's not priced in yet, as you get more interest from the investing public for the first time on a broad scale in almost 2 years.
The upcoming Brics meeting in Kazan is one of the most anticipated events on the economic calendar, and for good reason. If these nations decide to move forward with a new trade unit, it could mark the beginning of the end for the dollar's dominance in global trade. Let's not forget that the combined economic power of the Brics nations is substantial. They represent over 40% of the world's population and a significant portion of the world's economy portion of global GDP. The Brics countries are aware that relying on the dollar for international trade makes them vulnerable to the whims of U.S. monetary policy. The United States has used the dollar's status as the world's reserve currency to impose sanctions, exert economic pressure, and control the global financial system. Naturally, countries that don't want to be beholden to U.S. interests are exploring alternatives. Enter gold and silver. If the Brics nations decide to adopt a new trade unit that is backed by gold, silver, or a basket of commodities, it will change the dynamics of international finance. The demand for precious metals would surge as countries look to diversify their reserves away from the dollar and accumulate assets that hold intrinsic value. China, Russia, and India have already been aggressively buying gold. These countries are preparing for a shift in the global financial system, and they understand that gold and silver are the ultimate stores of value. By backing a new currency or trade unit with precious metals, the Brics nations would establish a level of credibility and trust that fiat currencies, especially ones controlled by politically unstable governments, simply can't match. The US dollar has held the status of the world's reserve currency since the end of World War II. This has given the United States a massive advantage in international trade, allowing it to run huge deficits without immediate consequences. But what happens if the dollar loses its reserve status? First, the demand for US dollars would plummet. Countries that currently hold large reserves of dollars for international transactions would start diversifying into other currencies or assets like gold and silver. This could lead to a sharp depreciation of the dollar, causing the prices of imported goods in the United States to skyrocket. Inflation, which is already a concern, could quickly spiral out of control. Moreover, U.S. treasuries, which have long been considered a safe haven asset, would lose their appeal. The U.S. government relies on foreign buyers to finance its debt, but if those buyers no longer have confidence in the dollar, they will demand higher interest rates to compensate for the increased risk. This would put enormous pressure on the U.S. government's finances, leading to higher borrowing costs and potentially triggering a fiscal crisis. For the average person, this means higher prices for everyday goods and services, rising interest rates on loans and mortgages, and a declining standard of living. In this environment, gold and silver become essential tools for preserving wealth. Unlike fiat currencies, they can't be devalued by reckless monetary policy. They've stood the test of time as stores of value, and they will continue to do so even if the dollar crumbles. In a post-dollar world, gold and silver are poised to play a much more prominent role. Historically, precious metals have been used as money because they are durable, divisible, and have intrinsic value. They don't rely on the creditworthiness of any government, making them ideal for use in times of economic uncertainty. If the Brics nations or any other coalition of countries decide to back their currency with gold or silver, it would represent a return to sound money principles. This move would provide stability in international trade and protect participating countries from the inflationary policies of nations like the United States. It's not just governments that are waking up to the importance of gold and silver. Investors around the world are starting to recognize that holding fiat currency in times of uncertainty is a risky proposition. Gold and silver provide a hedge against both inflation and geopolitical risk, making them indispensable assets in an increasingly volatile world. In addition to the Brics meeting, we're also approaching what could be one of the most pivotal U.S. elections in history. The political landscape in the United States is highly polarized, and the outcome of this election could have significant implications for the economy and, by extension, for the value of gold and silver. If we see a continuation of current policies characterized by massive government spending, low interest rates, and rising inflation, then the outlook for the dollar is grim. Investors will continue to flock to gold and silver as a hedge against currency devaluation. On the other hand, if there is a shift in policy that leads to fiscal tightening and a reduction in government spending, it could lead to a short-term strengthening of the dollar. However, given the enormous debt burden that the United States carries, any such policy shift would likely be unsustainable in the long term. One thing is clear: regardless of the outcome of the election, the structural issues facing the U.S. economy, rising debt, unfunded liabilities, and a dependence on foreign buyers for government bonds, aren't going away. These issues create a bullish case for gold and silver, which will continue to serve as safe havens for investors looking to protect their wealth. In conclusion, the world is undergoing a significant economic transformation. The dominance of the U.S. dollar is being challenged, inflation is eroding the value of fiat currencies, and geopolitical tensions are adding to the uncertainty. In this environment, gold and silver are not just investments. They are essential tools for preserving wealth and protecting yourself from the coming storm. Andy Schectman's insights have provided us with a clear picture of what lies ahead. Whether it's the actions of the Brics nations, the Federal Reserve's policy missteps, or the renewed interest in ETFs, all signs point to a bright future for precious metals. So as we navigate these next few weeks and months, remember that gold and silver have been stores of value for thousands of years. They've survived the rise and fall of empires, economic collapses, and global conflicts, and they will continue to hold value long after the current financial system has run its course. Whether you're an experienced investor or just getting started, now is the time to consider adding gold and silver to your portfolio. It's not just about making money. It's about preserving your wealth and securing your financial future in an uncertain world.